In this segment, I'll be talking about ratio analysis. We will be looking into Nikon, Sony, DJI, and GoPro. Ratio analysis encompasses looking into financial statements to gain insight into a company's liquidity, assets, and liabilities, and the operational efficiency of each company. First, we will talk about liquidity ratios. The first one is the current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations, or those due within 1 year. GoPro has a current ratio of 1.582. This ratio has increased in the past 2 years, making GoPro appear more stable. Having a ratio over 1 means they can pay off current liabilities with their assets, more specifically 1.5 times over. Comparing this to other rivals such as Sony with a ratio of 0.92, Nikon 1.934, and DJI 1.510. GoPro is better off than Sony, the same as DJI, but worse than Nikon. The quick ratio is an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligations with its most liquid assets. GoPro has a quick ratio of 0.972. This means that GoPro would be in the red if they liquidated assets and liabilities. Comparing this to rival companies, Sony with 0.671, DJI 7.607, and Nikon 1.264 shows that they aren't as liquid as DJI and Nikon. Next is leverage ratios. Debt to equity ratio is calculated by dividing a company's total liabilities by its shareholders' equity. GoPro has a debt to equity ratio of 2.292. This means they have roughly twice as much debt as they have equity, meaning that GoPro needs to stay strong and grow to be able to pay off all its debts. Comparing this to their rivals Sony with a 4.224, Nikon 0.915, and DJI 1.757, they tend to be average in this ratio analysis. The debt to asset ratio tells you the percentage of a company's total assets that were financed by creditors. GoPro has a debt to asset ratio of 0.696. This means around 70% of the assets they have are being financed by creditors. This can be a scary number because GoPro is only paid off or owns around 30% of its assets. Comparing this to their rivals, Sony 0.808, Nikon 0.477, and DJI 0.637, shows they're about at the industry standard, which is around 50 to 70% of assets being financed by creditors. Next is the activity ratios. The first one, the inventory turnover ratio, is an efficiency ratio that shows how effectively inventory is managed by comparing cost of goods sold with average inventory for a period. GoPro has an inventory ratio of 5.89. This means they turn over inventory around 6 times per inventory period. This is good as this ratio has been increasing for GoPro over the last few years, but still is behind fellow competitor Sony, which turns its inventory over at nearly 8 times. Next, the total asset turnover measures the value of a company's sales or revenues relative to the value of its assets. The asset turnover ratio can be used as an indicator of the efficiency with which a company is using its assets to generate revenue. GoPro has an asset turnover of 0.487, which is one of the lower ratios in their market. Compare this to Nikon with 0.581, Sony 6.077, and DJI 0.303. Lastly, we'll be talking about profitability ratios. The return on assets is an indicator of how profitable a company is relative to its local assets. Return on assets gives a manager, investor, or an analyst an idea as to how efficient a company's management is at using its assets to generate earnings. GoPro has a return on assets percentage of 4.5%. This means they're earning 4.5% on the assets they have, which is quite low. But compared to other companies in their sector, they are leading. Nikon has a 3.2%, and DJI has a whopping negative 62.8%. Lastly, the net profit margin is equal to how much net income or profit is generated as a percentage of revenue. GoPro has a net profit margin of 1.2%. This means they're on average only turning out a small profit, but a profit nonetheless. Compared to competitors, Sony at 4.5% and DJI with a whopping negative 2,000%. GoPro seems to turn over its inventory at a higher rate and has a solid current ratio. This implies that GoPro is getting their products moving and the firm has enough assets to meet its short-term obligations. However, GoPro's net profit margin is very low, which means profits are low. This is no surprise as the company has finally reached its first profitable quarter in 2018 for the first time in years. One major issue when comparing company ratios in this industry is the lack of a competitor with the same limited product scope that GoPro has. Nikon and DJI have other products in similar categories, and Sony has a very small portion of their revenues coming from the camera market.